Good morning. I'm Elizabeth Shane. Good morning. I'm Elizabeth Baste,
And I'm Nick Jurich.
and we're from Sutherland, Asbill, and Brennan. And on behalf of the Pro Bono Partnership, um, we are presenting planned giving, accepting, and attracting donations. So the first slide you'll see is the mission statement for PVPA, which is to maximize the impact of pro bono engagement by connecting a network of attorneys with nonprofits in need of free business legal services. And the next slide you will see is are the eligibility requirements to qualify as a client, and those include being a 501c3 nonprofit and serving low-income or disadvantaged individuals. And you can see the link for the website and upcoming webinars. And the next slide is just the legal information that we're presenting the general guidelines for planned giving, but that we're not giving you particular advice about your particular situation. So, an overview of what we're going to present today is what is planned giving, the advantages of planned giving programs, some types of planned giving, the most common to the more complex, and then make a distinction between what you may be considered as an endowment versus an unrestricted gift from a donor. And then also how you can facilitate planned giving and some resources that you could use to set up your own planned giving program.
Okay. Plan giving is in many ways exactly what it sounds like, which is a gift made during a person's lifetime or at their death that is planned, that is part of their overall financial and estate planning. The We use the term to distinguish that type of giving from maybe the more sporadic or annual fund type giving, to distinguish it from solicitations that a nonprofit might make from time to time, once a year, twice a year, from its donor base, um, to and to just that kind of regular giving. So we're trying to describe a deliberate, planned type of giving that usually involves some kind of working relationship between the nonprofit and the donor, where you're trying to both facilitate a gift, but also make it a part of the overall plan that giver has with regard to their assets and with regard to their estate. A planned gift can come as a just any time of the year or as a regular kind of gift, or it could be part of a capital campaign that the nonprofit may be engaged in. And that the reason it comes up during those is that a capital campaign usually lends itself to solicitations of larger gifts, and planned giving obviously lends itself very well to making larger gifts, because some of the techniques involved in planned giving are ones that enable a larger gift to be made or to be planned for. Usually, various planning or tax techniques are incorporated as well, and that's what makes it That's what makes it important to do it as part of the overall planning. There are advantages both for the donor, which is on the next slide, and for the charity. For the donor, uh, there are often income or estate and gift tax deductions that are available that essentially enable part of the gift to be funded by the government, because the donor is getting some break on taxes. There are often the ability to have a retained income interest. So, in other words, a client, a donor that feels in need of a regular income stream might be able to be facilitated through a planned gift. But there's also non-tax reasons or advantages to the donor as well, ranging from just the simple, what we often call the joy of giving, the fact that a lot of donors simply like to do charitable planning and like to be deliberate about their charitable planning, and the desire to leave a legacy, because planned giving allows, because it's not focused on just an immediate or one-time gift that's part of a regular giving, it's it's much it can be much more focused on a gift that lasts a long time. or some kind of recognition that lasts a long time. And that kind of legacy is often very attractive to donors. That's what, in many cases, they're after, to be remembered as well as to give. Some advantages for the charity. Because of the tax advantages that often come with planned giving, a nonprofit can often secure a larger gift than it might otherwise, or a more meaningful gift to the nonprofit than it might otherwise. There are advantages to the charity in that a planned gift might often be directed toward endowment and might be able to build up the nonprofit's endowment, and that's a gift that will then, in future years, keep on giving. Some charities provide, for example, that any non any non-directed gift, any gift that doesn't have a particular direction to it, that comes in as part of an estate, for example, which is the most traditional form of a planned gift, leaving a legacy in a will. Some provide that all those type of gifts always go to endowment, for example, as a sort of disciplining way of dealing with their planned gifts. Another advantage is that planned giving and encouragement of planned giving keeps the nonprofit in the minds of donors. Many charities invite their donors who are doing planned giving to become part of some special society, for example. And the reason for that is they want to keep in continual contact with them, because a donor who is inclined to engage in planned giving is a donor that is inclined to stick with the nonprofit. And also, planned givers are your best source for encouraging other donors. Your regular givers and the unplanned gifts might do so as well, but the planned givers obviously feel a much greater stake in the nonprofit and are going to be good sales persons for the nonprofit to others in their peer group. Okay.
So the type of planned gifts that we'll discuss today will be outright gifts. Those would be gifts of a certain amount or a type of asset. And then also gifts from IRAs and other retirement plan gifts, including gifts of life insurance. We mentioned annuities and other gifts and charitable trusts as other types of planned gifts, but we won't get into the creation of annuities and charitable trusts. Those are the type of gifts that usually have a lifetime interest for the donor, where they'll donate a certain amount to a charity and then retain a certain interest for the duration of their life, either an annuity interest or sometimes a lifetime interest in a charitable trust. Those are the more complicated planning that would usually be initiated by the donor's estate planning attorney, like us. So we won't get into those, but they're certainly something that could be on your radar. So for outright gifts, these are usually pledges, either an obligation at life or at death. And sometimes the pledge is in the form of an agreement between the charity and the individual during their life, or it's just found in a testamentary document like a will or a trust that might not be revealed to the charity until after the donor passes away. And usually those documents will have language that says, I give either this type of a cash amount or a non-cash asset, like appreciated stock, which has an income tax advantage to the donor, because if they give the appreciated stock, they won't have to realize the gain for income tax purposes. Often for a donor who wants to give an outright gift, generally they like giving during life, and then they also make a gift at death. And so encouraging lifetime pledges also makes it easier for the donor to give at death as well. Then for IRAs and retirement assets.
I can do that.
Okay.
But one more comment about the outright gifts. Often those will be, as Elizabeth said, done in the form of a pledge, so it could be a multi-year commitment, but very often they are just a single large sum as well. The multi-year commitment often lends itself better for the donor to be able to spread it out over a number of years, both for cash flow reasons and for tax reasons as well. But it may seem boring to just have a sort of one-time cash gift, but Those can often require a lot of planning to do, and very often are then coupled with a specific purpose or a plan that either the donor has or the nonprofit has to use with that money. It could be part of a building campaign, for example. There could be naming rights associated with it. It could be adding on a new room or a new wing or a new or new type of program in that. So they're not to be underestimated in terms of how much planning they might require. IRAs and retirement assets is a source for a planned gift, and a really good one. And the reasons for that are wholly tax. IRAs and retirement plan assets are some of the most heavily taxed type of asset because the tax on them is deferred until the IRA or retirement plan beneficiary takes the money out, at which time they're subject to full ordinary income tax rates, not to the lower capital gain rates. If retained at death and left to non-charitable beneficiaries, they will be both subject to possibly to an estate tax and an income tax. That means they're the best asset to leave to a charity. And a good nonprofit, when talking about a legacy gift, a gift that's going to be done in a will or trust, should always raise the subject of whether there are IRA or retirement assets that can be used to fund that, because that would be great help to the donor, because amounts from those assets that are left to charity are subject to zero tax, and so you obtain the biggest bang for the buck using those assets. The rules are now very flexible in how you can do it. You can leave a percentage, you can leave a dollar amount if they don't want to leave the entire retirement plan to charity. But an important planning thing to remember is that this kind of gift of an IRA or retirement asset cannot be done in a will. It has to be done in the beneficiary designation form for that IRA or retirement plan. And that means a bit of follow-up, since it's very easy for a donor to change the place in which they hold their IRA or their other retirement plan assets. And every time they change that investment firm or that custodian for those assets, they will often need to do another beneficiary designation form, and that can often be forgotten. So it makes it tougher because it's something that has to be kept up with, but it is by far the best source for a gift like that. Life insurance. Life insurance is another great one because often for the donor, they consider it a freebie type gift. They will often have a life insurance policy that really they no longer need because they obtained it at a time when they needed liquidity, perhaps for income replacement, perhaps to take care of dependents that they simply don't need anymore. Or they needed it for estate tax reasons when they thought they were going to have a large taxable estate, but now maybe they've got a charitable element to their plan that isn't going to require payment of a lot of estate tax. And so the life insurance is, they feel, no longer needed. But rather than just cancel it, they might be able to just give it or at death designate the charity as the beneficiary of the life insurance policy. Again, similar to a retirement plan or IRA, in which you have to do the beneficiary designation form. You can't, to name the charity as the beneficiary of it, you can't do it through a will. But it's also an asset that can be transferred outright to the charity as well. It would just then hold it until the death of the insured and get a gift at that point that cost essentially the giver nothing to give. Okay, moving on to endowments versus unrestricted gifts. We wanted to cover this because there's a lot of confusion in this area, and charities are subject to very particular rules under state law to governing endowments. And the first problem in this area is a definitional one, which is exactly what is an endowment. It's a term that can be used very loosely in the nonprofit and charitable sector, but it's got a very particular meaning when it comes to these laws that govern how to manage an endowment. An endowment is any gift that is restricted, any gift that is not wholly expendable by the charity on a current basis. If the charity is not permitted under the terms of the gift just simply spend it right then and there on its activities, it is considered endowment. Even if it is not going to last forever, but maybe some term for a certain term of years, or even if it's restricted to a very specific purpose and that that purpose is going to, in the next couple of years, come about and be used, if it's not wholly expendable currently, it's considered endowment. If a board decides for some large gift that was given to it that it is going to not spend it, it wants to hold it in reserves and calls it endowment, that doesn't make it endowment that's subject to the special rules about how to manage endowment. That's called a board designated fund or a board designated endowment. But because the board could at any time change its mind and spend it on a current basis, it's not considered endowment. The endowment, the restriction has to be on the charity and put on it by the giver or some third party to make it endowment. When it is endowment, it is then subject to the Uniform Prudent Management of Institutional Funds Act, or MIFA. Really, all funds held by a charity are subject to that act, but endowments are under particular rules, both as to how the dollars are invested, but also as to spending. And what the law requires for spending is that the charity adopt a prudent rule on how it's going to spend that endowment. Remember, it's not wholly expendable. Now, the rule that the charity might have to adopt might be determined by the terms of the gift that were given to it. The terms of the gift, as imposed by the donor and agreed to by the recipient charity, always control. If there are no terms on as spelling out how rapidly or how much can be spent from that endowment fund, though, the charity needs to adopt a prudent rule. Often a charity will have some kind of endowment spending rule that they've adopted for all funds that come into that charity that are designated as endowment. But they can adopt specific rules for specific funds. There is in the laws of some states a certain spending rate that's considered per se unreasonable because it's too high. Georgia, where we practice, doesn't have that per se rule, but you get instead what is considered a typical spending rate. And so often you'll see charities adopt a 3 or 4% kind of spending rate. Private foundations, for example, are required to have a 5% essentially spending rate under the excise tax rules that apply to private foundations. But that's considered on the high side for an endowment that is supposed to last forever. But as long as the rate is reasonable under the law that applies in Georgia, it can be adopted by the charity. But that's the point that we really want to get across is that the terms of the gift control, no matter how old that gift is. So sometimes charities are required to go back to very old documents, old wills, old instruments, gift instruments that govern the terms of the gift. But by all means, those are the terms that control. But then under MIFA, they're also required to adopt rules if that funds that they've received are not wholly expendable on a current basis. That's the endowment that is subject to the special rules.
So the next step, once you sort of know a little bit about plan giving, is how to facilitate it for your organization. We often find when a donor comes to us, some charities are more receptive, easier to work with when we want to give a large gift. And so some of the items that we recommend that you include on your website are really so that the donor has the ease of administration of setting up their gift and knowing about your charity. So the first step really is understanding a little bit about plan giving, but then providing donors with information about your charity. Everything from your exemption letter, your annual returns, your Form 990s, financial reports, all of that is much more accessible if you are able to provide it on your website, along with your full name, your address, your contact information. Pretty straightforward information that sometimes is difficult to find on your website. And so that language about, or your financial information and your contact information and how you want gifts to be given, the proper name, make things very simple for the donor to learn about your organization, make sure everything's on the up and up, and also to be able to name the proper charity in their will or in a pledge document. We often find that facilitating planned giving also is easier for if you have an investment account that can receive marketable securities. And that's usually a simple way for you to accept donations like stock and that donors may want to give. As long as you have an investment account open with your normal checking operating account, then you can receive securities. Also, you'll want to target your larger donors. So having a website that's easy to use will often be easier for you to target those larger donors. Our last slide is a resource that could be helpful to you, and that's that the Community Foundation of Greater Atlanta has a Plan Giving Design Center that includes information about plan giving tools, but also how to facilitate, how to approach donors, lots of great advice there for your side of receiving planned gifts.
A little more about facilitating plan gifts and working with folks like us, the plan giving advisors or estate planning advisors. That checklist on that previous slide on facilitating planned giving, I continue to be surprised how often and how it is difficult to find some certain kind of basic information about nonprofits. Even the smallest nonprofit that has a website ought to be able to provide the kind of basic information. Donors are becoming much more sophisticated about researching charities and wanting certain questions answered. You will often see, a charity have on their website, our Form 990 is available for inspection at our offices. There's really no reason for that. It's a public document, first of all, although it can be difficult for a layman to get at those public documents. But there's no reason not to have your Form 990 readily available so that either a donor or someone like us who wants to just make sure of something, if we're trying to integrate a nonprofit into a planned gift, for example, we're going to want certain things answered because sometimes the status of the nonprofit is going to make a difference with how our client is going to be able to implement that planned gift. There are certain trusts we set up that if a certain type of charity is going to be the remainderment of that trust, there's certain things we may not be able to do, or there's certain provisions we may want to put in. You can't predict everything that the donor community and their advisors are going to want to know about you, but you can make it easier for them to get the answers on their own. Of course, you'd love them to contact you, bring you into the planning, talk about all that. They may not want to do that right away. They may be exploring. They may be instructed that this is going to be done on an anonymous basis, and that they don't want to tell the charity about it until it happens. So providing that kind of information is important. The exemption letter, that just makes it easy for the charity, for the advisor to confirm that the donations are going to be deductible and that you've got your exemption in place. We have found, and one just came up a couple weeks ago, we find errors from time to time with how charities are listed in the IRS's own records about what kind of charity they are. We discovered what was thought to have been a public charity in town was actually a private foundation, which resulted in an enormous amount of work by them to correct their status and to go back to many of their donors that were other private foundations to do the kind of special work that is required when one private foundation gives to another private foundation. These were private foundations that thought they were giving to a public charity. So there's those kind of things are easier to fix the earlier they're found, and so it's good to be open. Many charities will put up planned suggested language for gifts. That's great, but just make sure it's accurate. Lawyers tend to want to draft and want to make sure they're using the legal names of entities and describing them in the legal way. If your charity goes by some name, but that's not its legal entity, note that, because very often we are going to be looking up the charity in both the IRS's lists, both its 990 and in the corporate databases as well, to make sure we're describing them in the same way. And so the more information you can give there, the better. And I do recommend that Plan Giving Design Center. There's really no reason for at least a smaller charity to have to reinvent the wheel when it comes to describing all the myriad of plan giving techniques that are available. You can piggyback on the community foundation, and there's others as well that have all that information in an easily accessible way. Those kind of charities, they're not trying to take your donors away from you. They're trying to facilitate donors giving to you, and so you don't have to fear using their materials or linking to their materials, because that's not going to turn a donor away who is inclined to work directly with your organization, to continue to work directly with your organization. But my basic message is the more help you can provide to donors and to the donors' advisors on what you are all about and how gifts can be made to you, the more likely you are in facilitating that kind of planned giving. Do we have any questions? Okay. Okay.
The question is, can IRAs be donated to a charity while the donor is living?
Good question, which is, can an IRA be donated to a charity while the donor is still living? For many years, the answer was no. But beginning in, I don't know, it's been around a while, Congress has had a provision that allows for a donor that has reached the age at which they can start having to take required distributions from their IRA, that they can give a portion of that IRA to the charity. And the key is that they can do that without having to take that amount they give into income, and thus have it affect their income determination, and maybe not get a full deduction for the amount that eventually goes to the charity. To facilitate that, the Congress does allow up to 100,000, or has in prior years up to 100,000, to be able to come from the retirement plan, have it count as the required distribution, and have it not be considered income to the donor, but rather just as long as it goes straight to the charity. The problem with this provision has been, in many recent years, is that it always expires at the end of the year and requires Congress to it's one of these provisions that Congress has been required to renew every year. They've refused to make it permanent. And often they do not get around to extending the provision until the very end of the year. If you recall just how Congress has been acting with regard to tax law over the last several years, it has often been subject to last-minute deals. There was one year in which they did not get around to doing it until after the year had already passed, and they retroactively brought it back for the previous year, meaning they had to give a date by which you were able to make certain gifts to charity and have it count as made in the prior year. As of now, in 2015, we don't have it in effect for 2015. It expired at the end of 2014. It is widely expected to be extended and be in effect for 2015. But here we are about to enter November, and we still don't know for sure. And when we don't know for sure, we are very reluctant then to suggest to clients that they make a $100,000 permanent irrevocable transfer from their IRA to charity when it may not be counted. But if Congress does extend it, as it has in, I think it's been about 7 years or more that this has been around, then it's a great thing to do. And so charities have been very frustrated with this provision because they would like to hit on their donors very actively from the beginning of the year. Give us part of your IRA, and it would be great if they could bring that up to their donors every time they see them or meet with them, but they haven't been able to until, in many cases, the last month or even the last few weeks, or, as I said, in a prior year. the previous year. There was one year we got it when the budget deal, I think it was the 2012 budget deal, where they extended it both for that year that had passed and for the whole next year. But that's the only one time I think they've done it in the last several years. But great question, because that is a great source for giving, because it's a zero tax. Okay. I can't think of anything more to say other than um, planned giving is very, from my experience in working with nonprofits, having a planned giving program is something that a charity means to get around to doing, but sometimes never does, because they know it takes a little work. But it doesn't take a whole lot of work in the sense that you can always bring it up to a donor, or remind them about the opportunity to do planned giving every time you reach out to your donor group. You'll see often many charities will just simply say, have you remembered us in your will? And the reason they do that is because they would like to start a conversation or start their donor in thinking about that. So it never hurts. Those kind of things may seem silly, but charities that do it, doing it for a reason, which is they're trying to start a conversation, because you never know where a gift to your nonprofit might suddenly fit in with a donor's long-term plan. There may be a specific event in their life that has come up, a specific family chain that now makes a charitable gift, a planned charitable gift, the perfect solution to something they might want to do. And if you're standing there ready to facilitate it at that time, you have a much better chance of getting it. Thank you very much for participating.